What's going on, everyone? The long-awaited Fed meeting took place last week, and as I have been saying for over a month now, they announced they would be doubling the taper and are looking at 3 rate hikes in 2022. But we'll take a deeper dive into Powell's statements to see if he and the rest of the Feds really mean it, and what it will mean to you as a buyer or seller in the coming year. Omicron fears and confusion seem to be growing, and that could also affect the Fed's plans and yours inadvertently. So, we'll look at some potential ways that could play out. And we'll also take a look at the global economic issues that seem to be escalating, which is another area of concern that the market does not seem to be too concerned about. But first, we'll take a look at the changes in Southwest Florida's housing market over the last 7 days and what those changes are indicating in our market trends. That's coming up right now. Welcome back, everyone. I'm Rick Harrison with MVP Realty in Southwest Florida. And in today's housing market for December 20th, 2021, we're looking at the Fed's new direction on inflation, Omicron fears rising globally, and international issues that seem to be escalating around us. And of course, our local market data and what it is indicating about our market conditions. But first, if you haven't already done so, please make sure to subscribe and click that bell to get notified of my latest videos bringing you everything you need to know about living, buying, and selling in Southwest Florida. And before we get into today's news, if you're more interested in one particular story, you can navigate to it using the chapters selection near the play button. All right, let's dive in. All right, so let's start off with the 7-day market update. As you can see, again, this week with new listings, they haven't changed. And actually, I just looked up the stats for new listings since 2008, since the market crash. And after 2011 to 2021, we've seen that the new listings that are coming on the market across all segments of Southwest Florida have stayed pretty consistent. So it's no surprise that the new listings coming on have been staying right around the same area since we've seen COVID really start. The big thing here is that the solds, again, from 761 last week are up to 919 this week. That's up 21%. Again, the same story. We're seeing the same amount of homes, or alternating between a little bit more, a little bit less each week of new listings coming on the market. But we're consistently seeing that there are more homes sold than coming on the market. So that is the same story this week. Again, extendeds, no real change here. It's been back and forth, but pretty consistent for extensions. Only 3 less than last week this week, and then pendings, that is down from 1,002 last week to 951 this week, which means a few less homes have gone off the market this week versus last week, but between about 50 homes, that's really not that much for the entire area of Southwest Florida for our MLS. So that's the big changes this week in the 7-day market update, and those trends really have been consistent since I've started doing these videos several months ago, and we're seeing the same trends. Interest rates as of 12/20. NerdWallet has the interest rates going from 3.015% last week to 2.994 this week, which is down just a couple percentage points. Same thing, Bank Rate also has the average from 3.25 last week to 3.24 this week, down 1 percentage point. As we'll get into the news, we'll talk about what the Fed just announced this past week as far as interest rates are concerned with the Federal Reserve, and how that's going to affect the interest rates going forward for the 30-year fixed mortgage rates. If you'd like more content like this, you can head over to my bio links in the description below and get access to loads of exclusive tools, data, and content like foreclosure and off-market property lists, buyer and seller guides, calculators, and the fastest and most complete property alerts on the web. So let's get right into it. So the Federal Reserve meeting announced they're going to be doubling the tapering from 15 billion to 30 billion taper. That's no surprise. I've been saying that for a couple months now, that I think they were going to be tapering. That's before even anybody was really looking at that. It just made sense, keeping the rates where they are and inflation continuing to rise. The only way that they can even try to combat inflation right now is to really reduce how much money they're trying to print and buy from the market to keep it propped up. And then that taper is going to be ending in March, and the increases in rates, the rate hikes, will be beginning around that time period, as far as what Powell said they will be doing. So they are looking at 3 potential rate hikes in 2022 that'll bring it up to around 4% for mortgages. Keep in mind, the Federal Reserve interest rates and mortgage rates are not the same. Then they're looking at 2 additional rate hikes in 2023, up to around 4.5%, and then another 2 in 2024, which will bring it up to about 5% mortgage rates, which on the average, if you look throughout history, 4%, 5%, not really a huge deal. We've seen 18% 18% mortgage rates in the 80s, 70s, and 80s. So on the whole, 4 and 5% is not that much of a jump, and still considerably affordable compared to history. However, because of where prices are for everything around pretty much every market, it doesn't matter if it's food, industry, textiles, things like that. All those things, because prices have increased, the fact that mortgage rates would increase, housing prices being so high where they are already, that 1% or even 2% increase is going to price just a lot of people out of the market. Not everybody, but a lot of people out of the market. Federal Reserve meeting. So a couple things that I thought were interesting. The market reaction. After the Fed announced it, the markets really didn't react the way I thought they would, where there would start to be a sell-off. I think everybody was hoping for a Santa rally of some sort in the stock market. Instead, it seemed like they dismissed what Powell was saying. I think even though Powell is speaking more hawkish, I think the market thinks he's going to be more dovish, and the market doesn't think that Powell can actually really raise the rates at the timeline that they have in mind, or they don't buy that it is. And I think that actually comes through in Powell's own words. And just based on the way he said it, I think Powell is still hoping that the inflation rate is transitory, and he thinks that the corrections in the economy, the supply chains, when that's corrected, he thinks that inflation is going to let up a bit. They were predicting 2% inflation. We're at 6, almost 7%. So they're 3 times what they thought we were going to be at. I think at this point in the game, I really don't see how they can get away with not raising interest rates. And even though the markets and I think the Fed are hoping that it's transitory, I don't see it happening. Let's take a look at the federal chair.
With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer-run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November.
So that just gives you a real brief overview of what Powell said. But if you want to watch the whole thing, there's an entire hour-long video on YouTube. You can look it up. Just look up the Federal Reserve announcement on YouTube, and you'll be able to find the whole thing and listen to his whole spiel on where they're headed and their direction. So moving on, Omicron in the market. So again, Omicron seems to be driving fear in the markets, even the stock markets. But just a couple things that I pulled out of a couple articles in the Washington Post. As Omicron drives a new phase of the pandemic, many are looking to Denmark, and particularly the government institute devoted to testing, surveillance, and modeling, for warnings about what to expect. We've already kind of gotten that from South Africa last week, but people are starting to worry just because it's starting to double. The rate of infections is starting to double around the globe, and we're seeing that everywhere in every market that is getting tested. Omicron positives are doubling nearly every 2 days, just like I said. And then the emerging answer, even in this highly vaccinated, wealthy Northern European country, is dire. So if you have the vaccine and the boosters, it's still doubling in those populations. So it's showing that the vaccines that we currently have, whether they were working before or not, are not working against this particular strain. Luckily, what we're seeing is that it's not as potent. So that's good news. And hopefully, after this Omicron variant, and we see what the actual what actually happens with it, we will see that the COVID-19 virus will turn into an endemic, similar to like the flu, and where we have vaccines, which I think is where we're headed with this particular um, virus. So, and then ever since the Omicron variant emerged in November, the best hope has been it might cause less severe sickness than the Delta version it is competing with, which in turn might make this wave more manageable and help the transition of COVID-19 into an endemic disease. Now we're going to take a look at the sentiment for buyers. If you're a buyer, if you're a home buyer or are waiting to buy a home, I think you're going to probably strike a chord with this video, especially if you're a millennial. So let's take a look at this clip and see what the market sentiment is for buyers.
Second problem, which might even be a bigger problem, is financial. Quite simply, millennials aren't doing so great from a financial perspective. They're not saving very much money. They have a lot of debt, and they really don't have the funds and finances to afford to buy a home. And you can see that exemplified on this graph. We're comparing three key lines here, everyone. Pay attention to what these lines are because it tells a very interesting story. The yellow line is the typical down payment for a home in America at a 5% down payment for a typical, let's say, FHA loan. And that typical down payment was around $5,000 in the late 80s, early 90s, and has since tripled to $16,000 in late 2021. So the typical home in America, 5% down, you need 16 grand to purchase the home. Well, obviously that's gone up a lot, and that's a big problem, everyone, because we can see here that the savings amounts for 35 to 44-year-olds, the blue line, and then less than 35-year-olds, the orange line, the savings amounts that these millennials, these young adults have in the bank has barely grown over the last 30 years, according to data from the Federal Reserve Survey of Consumer Finances. We see savings amounts stagnating while the down payment is going up, and this growing gap between the down payment and the savings amount means that more and more millennials are just priced out of the housing market. So even if a millennial did want to buy a home, say they did want to establish their own household and buy a home, they don't have the money to do it. And at some point, we're going to need the down payments to go down for millennials to have any hope of re-entering the housing market and being able to afford home.
So as you can see, the sentiment for millennials is that millennials are holding off on buying. One, just because they don't really need to buy, but the bigger factor here, I think, is because they're just priced out of it. So the investor sentiment as well. This article, right, in Seeking Alpha, somebody wrote an article. They've been looking at the long-term Treasury yields for the 10-year yield. It's remained stubbornly low. And when it does that in the kind of market that we're in right now, it's signaling a recession or that deflation is coming soon. So when you have all these things, it's what's called stagflation, where the economy starts to go into a recession because of inflation and these other factors working into it. So, and this particular person don't misinterpret Treasury yield signals. We are currently seeing dynamics that the market has not witnessed for over 70 years. That's arguable. You could probably compare the market that we're in right now to the 70s, late 70s, when we went into the high inflation, and then into the 80s where we went into a recession. But The Fed already fooled us about the inflation. They've been telling us that it's not transitory, and now they're finally admitting it. So he's saying don't be fooled by Powell's hawkish talk. He thinks, just like I said earlier, that Powell is talking hawkish, but he doesn't think that they're actually going to be able to go through with that, because they're worried that if they do raise the rates, it's gonna just put the entire market on pause, and it's going to put us into that stagflation where nobody's buying because inflation's high, and many of the other reasons that we're seeing. Also, is Shimao following Evergrande? So Shimao is another real estate company, another big real estate company in China. December is poised to be a record month for Chinese offshore corporate defaults after missed payments by indebted companies, including China Evergrande and Kaisa Group Holdings Limited. Chinese firms have defaulted on a record $3.8 billion in offshore bonds this month. That's compiled by Bloomberg, and the high was in January when Chinese borrowers failed to repay $2.7 billion of such notes. Moving on, the property tycoon losses in China, as you can see from this chart, I cannot pronounce these names, and I'm not even going to attempt to, but the owners, the billionaire tycoons, owners of these companies, you can see Evergrande at the top, $6.1 billion. Year-to-date losses, $17.2 billion. And you can see as you go down, not all of them are in as bad of shape as that, but they all have had some significant losses. And I think we're going to see that it's almost like a domino. As soon as Evergrande went down, you started looking around for all these other companies who've been doing the same types of, had the same kind of strategy or model for growth. And we're going to see those dominoes start to fall. I believe Shimao is in the same boat and will be following suit. So China real estate is struggling. Hang Seng Properties Index has declined 4.8% since December 9th, when Fitch declared China Evergrande and Kaisa in default. And then JP Morgan just downgraded Shimao Group on heightened liquidity concerns. Those concerns came over the fact that they just sold off a huge property management company that they owned. Even though there's not been any word about Shimao, they downgraded that. That downgrade caused the stock to drop, but they're also looking at potential liquidity issues because of the fact that they just sold off that profitable part of their business for $279 billion. $279 million. They just sold that off, and everybody's looking at that. Why did you sell that off? Are you having liquidity issues to come up and pay your debts? So they're wondering if that's going to follow suit with Evergrande. And then also, obviously, of course, our market variables that we're looking at and we need to keep an eye on. Omicron variant reactions. The market has been reacting pretty rough the last couple of days, so you're seeing that sell-off. Just keep an eye on the futures of the market. Fed's upcoming meetings in 2022, so we'll have to see if they're actually going to follow through with what they said and what their plan was to move forward in 2022. Historically high inflation. Then the Treasury yields, keep an eye on those. They have been making some ripples in the water as far as people who have been paying attention to the markets. And then obviously Chinese real estate sector is a huge issue that could have waves into the rest of the economy. So thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know, and don't forget to subscribe and click the bell for more videos every week, like real estate tips, new listings, things to do, and more. If you have questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to the Southwest Florida MLS. Thanks again for watching to the end, and I hope to see you next week.